Welcome back to Street Smart. I'm Matt Miller here on the floor of the New York Stock Exchange. Christine Lagarde, the new managing director of the IMF, said this weekend that the world economy is in a dangerous new phase. And today, ECB President Jean-Claude Trichet warned about Europe's slowing growth and inflation risk, something that we've obviously been paying a lot of attention to on this program as well. And joining us now are two guests that we often have on to talk about those things, although often from opposing viewpoints. Mark joins us from Southwest Securities, the managing director there. His out-of-the-box newsletter is read by 5,000 financial institutions. And Axel Merk, who oversees more than $750 million in currency-focused assets at Merk Investments, joins us as well. Gentlemen, thanks for coming on the program. I wondered this morning, after reading much more about what Christine Lagarde said over the weekend, if the two of you are now going to come together as far as your views on Euroland, or if it pushes you even further apart. Mark, let me start with you. What do you think of the new managing director of the IMF?
Well, I think the point that you made was accurate, that it's a solvency issue for the banks. They have $4.1 trillion to roll over in the next 15 months. What I was amazed with was the response of the European Central Bank and some of the other countries in Europe, where they just snubbed her position totally and said, we don't need to recapitalize the banks. And I think that decision is going to prove to be very costly in the long end.
Axel, your response?
Well, a couple of things. First of all, the European Central Bank every month in its communique says that the banks need to raise more capital. But there's one point the policymakers are right on, is that even if you have a Tier 1 ratio of, say, 12%, you still need to finance the remaining 88% of your balance sheet. And if you take, say, a second-tier Spanish bank that has a great balance sheet, those banks are nonetheless shunned from the financial markets. So it needs much more than a recapitalization. But I do agree, yes, that many of these banks need to capitalize more. And in that context, this latest round of stress tests was very helpful because it provided disclosure. And we don't need the policymakers to say these things. The market is in charge. The market will target the banks that are undercapitalized, and then these banks will move. We can't wait for the policymakers, and that's how it's been throughout this crisis.
If we wait for the policymakers, Mark Grant, let me ask you this. The idea that the EFSF, the European Financial Stability Fund, will eventually sort of come in when it's finally all put together and said and done and be sort of Europe's TARP, does that make you feel any better?
No, I think the proposal for the stabilization fund is a convoluted effort. You'd have to go back to each national government. I think the way they have it structured, like the way they have many things structured, is going to make it virtually impossible to come up with any satisfactory solution. And even the expansion of their powers to help with the banking system, as an example, versus the sovereign debt fund, you have to say that there isn't enough money. There is not nearly enough money to support this effort, especially as Italy, which I suspect is going to be in a lot more trouble in the next few quarters, along with Spain, and there's not enough liquidity to bail anything out of that size.
Do they fall apart? Does the European Monetary Union fall apart, Mark Grant?
Well, the EU could fall apart in three ways, which I've commented before on, and that is the funding countries decide on a nationalism basis, they don't want to supply any more capital. Some country being funded, though I doubt it, might say, we can't deal with the austerity measures. And the third way is that the markets are going to say, we're not going to fund, or they force the funding yields high enough so that you have an exacerbated effect, so that the banks start putting out worse and worse quarters as the cost of funding eats up all their profits and they go into the red.
Axel, let me ask you, what does this mean for the U.S.? Should we actually see a country leave the European Union? How much does that destabilize the U.S. markets?
Well, first of all, I'd like to point out that, as you point out, what are the implications? And I fully agree that we have a lot of pain, but this pain will be expressed in the spreads in the bond market, in the funding costs. The euro, remember, the euro is around 145 now. It's not at parity. We have this dialogue between the bond market and the sovereigns and the banks. In the U.S., the key difference is that the bond market is behaving, and as a result, we're not instituting any meaningful reform. Now, mind you, at some some point, the U.S. bond market will act up, and at that stage will come the time where we'll institute reform. The key difference is that in the U.S. we have a current account deficit. So when our bond market acts up here, it's going to be far more painful as far as the currency is concerned versus Euroland. In Euroland, it's an ugly process. We compare it to the sausage making of the healthcare report, or look at the debt ceiling debate. The process is ugly. But think about in Europe, if in Germany the government were to be kicked out, well, the opposition wants to have a Marshall Plan and Eurobonds. In Spain, we may have a new government in November. Well, the only thing is the new government is going to own the problem and accelerate reform. It's a process that will drag on, but it's a process that will come on the heels of a stronger euro precisely because they're spending and printing less money. But by all means, it's going to be ugly and painful.
Mark, I want to get your perspective on this. Does this destabilize the U.S. market, or do we merely see potentially some difficulties in the lending market, some widening of spreads in the credit markets here in the U.S.?
Well, the markets are all interconnected, especially at the international bank level. So certainly any blow up in Europe, any of the three possibilities that I just gave you, would have a tremendous impact on the United States in terms of our financial system. The other thing to point out that's quite interesting right now is that our banks, the yield on our bank debt is much less than the yield on most of the bank international debt. Well, as a matter of fact, the spreads are at an all-time wide, and I think they go wider from here. I think the euro, this is just my view, is a concocted market, a manipulated market by the EU and by China to some extent. And also don't forget that most energy trades in dollars, so it gives the European Union a huge advantage to buy energy at much cheaper prices.
Well, the manipulation came in, if I jump in here, the manipulation came from U.S. money market funds providing cheap funding to European banks, them issuing commercial paper U.S. dollar denominated. As that has come under scrutiny, U.S. money market funds have been reducing their holdings, and sure enough, the cost of funding has gone up in the Eurozone. That's not a new crisis. It's the same issues coming up again, and that is highlighting the weaknesses in some of the banks. The market is targeting those banks, and sure enough, those banks will raise more capital. And so I'm not saying all is well in the Eurozone, but it's a process, and as this process plays out, we will step by step fix some issues. There'll be plenty of complaining to do, but as far as our market is concerned, the currency markets, we love the euro because everybody hates it, calls about the end of the Eurozone, and look where we are. We're not at parity. We haven't fallen apart. We are in this situation because we're doing the opposite of what the U.S. is doing. Ben Bernanke wants to debase the dollar, and somebody has to be on the other side of the trade. That means you're going to have a lot of pain, less economic growth, but a stronger currency.
Why do you think, Mark Grant, that we have such a strong euro here? I mean, relative, obviously, to where it's been, it's still holding up.
Yeah, the euro is an interesting part of the markets. I think, as I said, and I truly believe this, that the European Union and China are manipulating this market. I think it's a very convoluted market right now. And I think given all the problems in Europe, it's very difficult to understand why the euro has held up so well, with the exception that it allows them to buy energy, oil and gas, much cheaper because a lot of the contracts are in dollars. And so that's why I think they struggle very hard to keep a high euro. I mean, I think Axel and I have great respect for Axel. He and I are looking at the same set of facts. We've just reached different conclusions.
Well, the reason we reach different conclusions is because I believe in the currency market you have a $4 trillion daily turnover. It's the market dictating the terms. It's not the policymaker that are dictating the terms. If one takes that view, one always thinks about conspiracy theories. The policymakers are reacting. We wouldn't have had any reform in the Eurozone if it weren't for the markets applying those sort of pressures. And by all means, the Chinese may be buying some euros, but they've also been subsidizing the U.S. And so you can always think of some policymakers trying to manipulate something. Ultimately, it's the markets calling the shots, and the policymakers are reacting.
All right. Unfortunately, that's always we have time for, but I can't wait till the day I get both of you in New York and we go to the bar together to talk about these issues. It's great. It's great to have you both on, and I really appreciate it. Axel, thanks very much. Mark Grant, really appreciate you giving us some of your time. We're going to